First, we'll walk you through how to read a stock chart. We'll talk about some technical indicators, how to use those to increase your trading probabilities, and combine them with other indicators and chart patterns. We'll also look at a few technical oscillators, what exactly those are, how they're designed, and what they tell you about where a stock is headed, whether it's in an overbought or oversold condition, and whether the oscillator sees a turn in the trend the stock is in. We'll look at a few chart patterns. We'll look at some continuation patterns that give us an opportunity to buy into a stock that's already in a bullish trend, or perhaps short a stock that's in a bearish trend. We'll also look at candlesticks and a few candlestick patterns, including how to read a candlestick and what the candlestick is telling us. Combined with all of these, we'll talk about trading psychology, what all of the indicators and patterns tell us about what investors are thinking when we see price movement in a stock, and how being able to read investor psychology, especially around support and resistance levels, can add a lot of percentage points to your trading. As we go through the course, as I said, we'll talk about analyzing a stock chart. We're going to talk about line charts and bar charts and candlestick charts. We'll talk about how to use support and resistance and how they can set you up for entry and exit points in a stock, which give you a high probability of winning. We'll talk about how to use the technical indicators and oscillators to predict both upcoming trends as well as continuations in trends and trend reversals. And we're going to talk about chart patterns and how those can also help you identify trend reversals and trend continuations. With each of the items that we cover, we'll show a real-world example on a chart so that you can see how to use the indicators or how to read the chart patterns and apply them in your trading. So with that, and I'd like to welcome you to this course. There are a variety of types of stock charts you can use, and we'll be looking at some real-world examples in just a moment. Some of the types include a line chart, a bar chart, and a candlestick chart. I'll show you the line chart and the bar chart, as well as the candlestick chart, but throughout the course, we're going to be using candlesticks as our main charting tool. And in just a second, I'll go over the graph on the left to describe how a candlestick works. A stock chart shows a daily, hourly, or weekly, or by the minute movement of a stock and provides the open, high, low, and close for the time period. So if you're looking at a daily chart, then each bar or candlestick is going to represent one day. If you're looking at an hourly chart, then each of those would represent an hour on the chart. A line chart, which we'll see in just a minute, gives the closing price for the time period you're looking at. So if you're looking at a daily chart, it'll give you the closing price for the day. Charts are important because they allow you to determine if the stock is in an uptrend, a downtrend, or a consolidation pattern, which basically means moving sideways between two prices. So let's talk a second about the candlesticks on the left. We'll have two types of candlesticks, a red candlestick and a green candlestick. And these will be the predominant candlesticks on a candlestick chart. You can have a candlestick which is neither red or green, which basically means the stock opened and closed at the same price for the day. Let's talk about the design of the candlestick. You'll have a green or red body, which is shown here. That's the body of the candlestick. And then you'll have a wick. You can have a wick on the top and a wick on the bottom of the candlestick. Each of these is a wick. So for our green candlestick, the top point of the wick is the high price for the stock during that time period. And for this example, I'll use a daily time period. So this is the high price for the day. The high part of the green body is where the stock closed for the day. The low part of the green body is where the stock opened on the day. And then the low part of the wick beneath the body is the low for the day. The red candlestick is very similar. The high part of the wick on top is the high for the day. But with a red candlestick, the stock has opened in the body at the top of the red body, and it closed for the day at the bottom part of the red body. The bottom wick represents the low price for the day. And we'll see candlesticks over and over on the charts. So if you're a little confused right now, that's okay, because we'll be going over these quite a bit. So let's take a look at a couple of stock charts where I can show you the line chart, the bar chart, and the candlestick chart, and also show you what a trend looks like in a stock. Throughout the course, we're going to use tradingview.com to show charts. So I'll show you how TradingView works and how we can look at various charts using TradingView. In the upper left corner, we'll put in the symbol for our stock. So here we've typed in BAC for Bank of America. You can choose the stock from a drop-down list. The next box over gives us our time frame. So in this case, we're looking at a daily chart. We can look at a chart by the minute, by the 15-minute, 45-minute, hourly, daily, weekly, and monthly. As I said, here we're using a daily chart. The next box over tells us the type of chart that we're going to be looking at. So we're first going to look at a line chart. And the line chart gives you the closing price for the day. If you look at the top of the chart, it will tell you on the day that you're looking at what the open, the O is the open, H is the high, and the prices are changing because as I move the cursor, it's moving from day to day. The low for the day and the close for the day. So if we pick a day, we can look at the bottom of the chart. It'll give us the day. So on July 13th of 2018, the stock opened at 28.62. The high for the day was 28.69. The low for the day was 28.22. And the close for the day was 28.55. This will be true on all the types of charts we look at, on the line chart, the bar chart, and the candlestick chart, that it will give you the day at the bottom and the open, high, low, and close at the top. So now let's look at a bar chart. I'm going to zoom in a little bit so we can see the bars. So if we look at the bar chart, it's in two different colors, red or green. The red shows a down day and the green shows an up day. On the left side of each bar will be the open price. You'll see the horizontal bar, which represents the open price. On the right side is a horizontal bar that represents the closing price. Just like with candlesticks, the high of the day is represented by the top of the bar chart, and the low of the day is represented by the bottom of the bar chart. So on this day, August 13th, 2018, the stock opened at 31.08, which is the horizontal bar on the left. The high was 31.12, which is the top of the bar. The stock closed at 30.48, which is the horizontal hash on the right side of the bar. And the low for the day was 30.45, which is the bottom of the bar. Now let's take a look at candlestick charts. And let's look at that same day on the candlestick chart. Here on August 13th, everything is the same, the open, high, low, and close. You can see there's a very small wick at the top, which represents where the high of the day was. A very small wick on the bottom. The stock opened at 31.08, as we said, and that's the top of the red body, and it closed at 30.48, which is the bottom of the red body. Now let's take a look at a green candlestick. Let's look at August 31st. We'll see that the stock opened at 30.88. It dropped down to a low of 30.62. It reached a high of 30.95 on the day, and then closed at 30.93. And you can see that the close and the high are very close to each other, so there's almost no wick. You really have to zoom in to see a very tiny wick at the top. So that's how we read a candlestick on a chart. Now let's take a look, again using Bank of America. I'm going to zoom in, and we'll look at some trends in the stock. At the beginning of this chart now, in November of 2017, we have an uptrend in the stock. I'm going to draw a trend line here. So we have the stock moving up in an uptrend. Then the stock moves in a consolidation pattern, and I'll draw a support line. And don't worry, we'll talk about support and resistance in our next video. And a resistance line here. So basically the stock trades sideways in a consolidation pattern. The stock then moves into another uptrend here. And then this is followed by a downtrend when the stock is falling in price here. So here we have a couple of different uptrends. At the beginning of the chart, we have an uptrend as the stock moves from $26 or so to around $32.50. A consolidation pattern as the stock moves from $31.50 to $29. The prices are all shown on the right-hand side of the chart here. And as we move the mouse up and down, you can see the price change. We then have an uptrend here, again as the stock moves to around the $31.50 and $32 level. And then a downtrend as the stock moves from $31.50 back down to the $26 level. So that's how we read a chart in TradingView. That was an example of a line chart, a bar chart, and a candlestick chart. An uptrend, a consolidation pattern, and a downtrend in Bank of America. Support is a price which a stock trades down to and then generally moves up in price. If you look at our graph on the left, the stock has moved down to this support level and is now trading or bouncing up off of support. The stock then trades up to what is called a resistance level, and that is a price which a stock trades up to and then generally moves down in price. And then the stock trades back down to the support level, where it will generally move up in price from that level. And I say generally because a stock will go through both support and resistance, and this can happen on a fairly regular basis. But we can use support and resistance to provide sell and buy signals in our stock. They provide areas where there is a higher percentage chance that the stock will move either up or down, depending on whether it is at support or resistance. A break of support or resistance may signal a strong move in the continued direction of the break for the stock. So a break through support may indicate that the stock is going to move down, and a break above resistance may indicate that the stock is going to move up. The longer a support or resistance level is in place, the more important the signals that the support or resistance level provides. So a multi-day support level is more important than a multi-hour level, and a multi-week level of support or resistance is more important than a daily level of support and resistance. You can have both major and minor levels of support. The major would be at the higher time frame and in place for a longer period of time. And then you can have minor levels of support and resistance in shorter time frames. Or these can be set up within major levels of support and resistance. So let's look at support and resistance on a chart. We're going to start with a chart of Intel, and here I've entered INTC in the upper left portion of the chart. It's a daily chart. We're using candlesticks, and I'm going to draw a support and resistance level at the beginning of this chart. Here, we have a resistance level, and here, we have our support level. And as we can see, the stock traded in this range between resistance and support for more than a year. This is September of 2016, all the way up through September of 2017. This is an example of how important it is when a long-term support or resistance level is broken. So when the stock broke through this resistance level, right around $38, you can see the stock then made a huge move to the upside, eventually reaching right around $57. So the stock had been trading in this range or consolidating for over a year, and when the stock broke through resistance, it made a large move. One of the reasons stocks make large moves when breaking support or resistance is because the stock is doing something that most investors do not expect. At a resistance level, you expect the stock to turn back down and move lower. And at support level, you expect the stock to bounce or move up off of that support level. When a stock breaks through a resistance level, investors that have sold the stock at this level, thinking that the stock is going to go down, now must re-enter the stock, causing it to move up. And the same thing with a break of a support level. Now let's take a look a little closer in time. So we're going to use multiple time frame analysis to look at how we might want to trade Intel today if we were going to enter the stock. So we have those support and resistance levels in the past, and now the stock is trading higher. So we have a support level just above 42 that we'll draw in, and then we're going to zoom in to an hourly chart. And here we can see that there are support and resistance levels on the hourly chart as well. Right around 49 is our resistance level, and our support level remains here just above 42. This is our major support level. If we zoom out, we'll see that this is a minor resistance level. And we'll go back to a daily chart, and we see the minor resistance level as the stock is bouncing up in a downtrend. Our major resistance level at this point would be the high that the stock reached just below 58. So there we have an example of a major and minor resistance level early in the chart. We saw a break of the resistance level and the stock move up strongly to this 58 level. We now have a major support level in place just above 42, which the stock has touched several times in early 2018 and in October of 2018. And we have a minor resistance level right around 49, where the stock has bounced up to after touching support just above 42. So that's an example of support and resistance in the stock of Intel. In this video, we talked about resistance and support levels that we could draw horizontally. And those work well when a stock is not moving in an uptrend or downtrend, but in a consolidation range. A simple moving average is calculated by adding together prices in a given time frame and dividing by the number of time frames. So a 20-day simple moving average would take the closing price for the last 20 days, add them all together, and then divide by 20. The EMA, or the exponential moving average, is calculated in the same way, except the closer in time frames, so the closer days are given more weight than further out days. So yesterday's closing price would be given more weight than the day before, which would be given more weight than the day before. We can use EMAs in a couple of different ways. We can use an EMA as a support or resistance indicator, or we can use two EMAs with different time frames to get an indicator that will give us a buy and sell signal. And I'll show that to you on a chart in just a moment, but we'll have a fast line, which will be represented by the lower number of time frames, and we'll have a slow line, which will be represented by a higher number of time frames. So for example, we could have a 20-day line, which would be our fast line, and a 50-day line, which would be our slow line. You'll hear of two particular types of moves with an EMA. One is called the golden cross, and the other is called the death cross. The golden cross is when the 50-day exponential moving average crosses above the 200-day exponential moving average. And the death cross is the opposite. It's when the 50-day EMA crosses down below the 200-day EMA. And these are two types of crosses that are paid particular attention to with the S&P 500 or the Dow Jones Industrial Average. But they can also come into play in individual stocks. So let's look at the EMA on a stock chart. Let's use a chart of Wells Fargo to demonstrate how we will use the exponential moving average. So we type in WFC in the upper left, and that gives us Wells Fargo. We move over to indicators, type in EMA. It comes up as moving average exponential. We're going to click that, go to format, and we're first going to look at the 50-day exponential moving average. So we hit OK, and this brings up the 50-day exponential moving average. With the exponential moving average, we want to be short or not long the stock when it's trading under the exponential moving average, and we want to be long the stock when it's trading above the EMA. So if we start at the beginning of the chart, we see the stock is below the 50-day exponential moving average, and it's in a downtrend. I'll add a downtrend line here. And it's below the EMA. So we'll use the EMA as our support and resistance level. When the stock moves above the EMA, as it does here, we would get long the stock. The stock moves from 54 to around the 56 level, comes back and closes below the EMA, moves back again, positive through the EMA, and then comes back through the 50-day EMA again to the downside. So we may have taken a couple of trades here that were losing trades, or we did not make very much money on these trades. And then the stock moves above the EMA again here in June. Closes above the EMA in July, so we're still above, and we're still long the stock. And we get a move from around the 55 level up to around 59 before the stock gives us a sell signal here in September, and then Wells Fargo moves to the downside. So we can see in the uptrend, the stock is generally above the EMA, and then as the stock crosses to the downside, we get a downtrend in the stock. So that's how we would use a single EMA to give us a signal as to whether the stock is moving up or down. Now, let's change our EMA. We're going to go to Format again, and we're going to use a 10-day EMA, which is going to be our fast line. We're going to add another EMA. So go back to indicators, type in EMA again, click on moving average exponential. And for our second EMA, which is going to be blue, we're going to make that a 20-day EMA. Here we see the 10-day crossing the 20-day and giving us our buy and sell signals. Here, where we marked it earlier, we have the 10-day moving above the 20-day after the stock had been in a downtrend. It stays above the 20-day until June. We get a cross to the downside, and then another cross to the upside as the stock is in an uptrend here. So by using two different EMAs, we get a little clearer signal as opposed to just using the single EMA by itself. And as we can see here, the 10-day crossing the 20-day to the downside would have given us a signal that the stock was moving into a downtrend or that we would not want to be long the stock. If you want to generate more trade signals with your EMA, you can use a shorter time frame. So in this case, we're using a 10-day and a 20-day, but you can use a 5-day and a 10-day, and you would get more buy and sell signals. And if you want fewer buy and sell signals because you're trading on a longer time frame and you don't want to move in and out of the stock as regularly, then you would use a larger time frame. So you could use a 20-day and a 40-day, and it will give you fewer buy and sell signals in the stock. So that's how we use the single EMA as well as the combined 2 time frame EMA in the stock of Wells Fargo. The MACD is a type of exponential moving average. It subtracts the 12-day exponential moving average from the 26-day exponential moving average to get one line, which is the MACD line, and then it combines this with a 9-day exponential moving average as well as a 0 line that the MACD and the 9-day EMA can cross above and below. A cross by the MACD above the 9-day line is bullish, and a cross by the MACD below the 9-day line is bearish. A cross above the 0 line is bullish, and a cross below the 0 line is bearish. Though crossing the 0 line is less important than the MACD crossing the 9-day line. When the stock price moves higher, as the MACD moves lower, we have a divergence. And this is a negative divergence. When the stock price is moving lower and the MACD is moving higher, then we have a positive divergence. A negative divergence tells us that the stock may cease to move higher and either turn down or move into a consolidation pattern. And a positive divergence tells us that the stock may cease to move lower and move into a consolidation pattern or possibly move higher. A cross in the MACD often indicates a trend change, especially if the MACD is in a bullish position well above the 0 line and then crosses the 9-day to the downside. This may indicate that a bullish trend is becoming bearish. And just the opposite, in a bearish trend, if the MACD is extremely oversold and the MACD then crosses the 9-day to the upside, this may indicate that the bearish trend is turning bullish, or at a minimum, turning into a consolidation pattern. So let's take a look at the MACD on a chart. Let's use a chart of ExxonMobil, XOM, on a daily basis to look at the MACD. So we're going to click on Indicators, type in MACD for the MACD, click the MACD, close this box, and then we have the MACD at the bottom of the screen. The center line is the 0 line for the MACD, and the blue line is the MACD line, and the red line is our 9-period EMA. Let's start at the beginning of the chart. We have the MACD in bullish territory above the 0 line, trending up, and then we get a cross of the MACD here, actually before the stock dropped off. So we had a cross of the MACD, which is in overbought territory at this point, to the downside, and then the stock drops. So with this cross, we may have sold our position or at a minimum tightened our stops and been prepared for a reversal in trend from a bull trend to, at a minimum, a consolidation pattern, but the stock actually went into a bear trend. The MACD drops along with the stock, and then we get another crossover of the MACD here. And this is a bullish cross of our blue MACD line above the red 9-day line. We get a short rally in the stock, but then the stock continues down here as the MACD continues up. So this is a bullish divergence in the MACD. We have the price of the stock dropping, the price of ExxonMobil dropping, and the MACD rising. So this should tell us if we're short the stock to tighten our stops and possibly look for an exit of our short and prepare to go long. The MACD crosses the 0 line, which is bullish. The stock moves up. We then have the MACD continuing in bullish territory. It's above the 0 line until across here, back below the 0 line. The stock continued to move up as the MACD was in bullish territory, and as the MACD moved below 0, we have the stock coming back down and breaking this support level. And then we have another buy signal in the MACD, which is an oversold, but not in extreme oversold position, as it was back in February. So with this buy signal, if we had taken a short position here, we'd be ready to exit that position and perhaps ready to go long, as the stock had almost touched a major support level here, dating back to May. So we have a major support level combined with a buy signal in the MACD, which again would have us exiting our short position and possibly taking a long position. The MACD confirmed by crossing the 0 line in early September, and the stock continued up from the $80 level to around the $87 level. We had another sell signal in our MACD, which was overbought at this point. So this sell signal would have told us to tighten up our stops, and then we see the stock fall off again, and now we're in a buy signal in the MACD right now. So that's the MACD combined with support and resistance in the stock of ExxonMobil. The RSI is calculated in the following manner. RSI equals 100 minus 100 divided by 1 plus RS. And RS is the average gain in end periods. So if we're talking about days, then RS is the average gain in days minus the average loss in that same number of days. Usually the RSI is calculated on a 14-day period. You can change this time frame, but that is the standard N that we're talking about. RSI provides buy and sell signals when a stock reaches an overbought or oversold condition. RSI is an oscillator, meaning it moves between 0 and 100, and we use it as a trend reversal indicator. It's best to use RSI with other indicators, such as support and resistance, because you'll often find overbought or oversold conditions around support or resistance. So when RSI rises over 70, we're going to look to sell the stock, or at a minimum, we're going to look to tighten our stops and be ready for the stock to turn down. When the RSI is under 30, we're going to look to buy the stock, as the stock is in an oversold condition at that point. Some traders like to use 80 and 20 as opposed to the 70 and 30 level with RSI. So if you're a more conservative trader, you're going to look to sell a stock, or again, tighten your stops when RSI reaches the 80 level, and you're going to look to buy the stock when RSI dives under 20. We're also going to look for divergences, just like we did with the MACD. So we'll look for both positive and negative divergences. If the RSI is moving down and the stock is continuing to move up, we have a negative divergence. And if RSI is moving up and the stock is moving down, then we have a positive divergence. Let's look at RSI on a chart and see how we would use it in our trading. Let's use a chart of Tesla to look at the relative strength index. So here we have Tesla, TSLA, which is typed in the upper left portion of our TradingView screen. We're looking at a daily chart, and we're going to go to Indicators and type in RSI. We see the relative strength index. places the relative strength index at the bottom of the screen. And we can see in mid-June that the RSI gave us an overbought indicator. This line represents the 70 level. The RSI went through 70 and actually went up to around the 78 level. So this was giving us a sell indicator, and we would either sell or tighten our stops if we are long the stock at this point, which had been in an uptrend here. And we see the stock, after the RSI gave us the sell indicator, sold off. The stock had been trading, it went to a high here of 370, 373. And then in the sell-off, it went down to a low of 286.13. So that was a nice move down in the stock with the sell signal provided by the RSI. The stock bounced, and we got another sell signal on the RSI here when it touched 70. So on this strong move up in the stock, the RSI was telling you that the stock was overbought at this point. And again, we would either sell our position or tighten our stop at this point. The stock trended down, and we actually get a buy signal in early September. Here the RSI gives us a buy signal as it drops through the 30 level, telling us the stock is oversold at this point. And we get a nice rally in the stock from around 260 up to around the 315 level. So that's the RSI with Tesla. But let's zoom out a little bit. And what we'll see is that the RSI, if we draw in a couple of trend lines, we have support here around this level. We have resistance here, which the stock did move through, but then came right back through within a day or two in each case. So if we had used resistance and support along with our RSI indicator, that would have given us more confidence that the trades were correct at this point. RSI is an oscillator that is best used, if you can use, with a support and resistance level. So that's RSI combined with support and resistance in the stock of Tesla. A double top is when a stock trades up to a resistance level 2 times in a relatively short time frame. And a double bottom is when a stock trades down to a support level 2 times in a relatively short time frame. As you can see from the graph on the left, we have the stock in an uptrend. It moves up to a resistance level, has a pullback to a pullback low, moves up a second time to the resistance level, and then pulls back and dives lower than the first pullback low. So basically with a double top, you have sort of an M pattern, and with a double bottom, you're going to have a W pattern. And when the stock breaks out of the pattern, as it does here on the right side of this graph, and moves lower, that is your signal to either sell the stock if you're long or go short the stock. The psychology behind the double top is that the stock has traded up to resistance and has failed to penetrate higher, so the bulls have started to lose control. The stock has a pullback, and instead of rising and going through resistance the second time, which would confirm the bullish pattern, the stock peters out at the top a second time, showing that the bears are now in control of the stock, and then the completion of the pattern when the stock drops lower than the first pullback indicates a reversal in the bullish trend and that the bears are now in control of the stock. And the same is true for the double bottom, with the psychology being that the stock that has been in a downtrend is now reversing course because it has failed to break through a support level 2 times in a row. And now the bulls are taking control as they take it higher than the pullback high reached in the double bottom pattern. Let's see what this looks like on a chart. Let's take a look at a double top in the chart of Advanced Micro Devices, or AMD. We have the stock in a clear uptrend. It's moving up here. We have a pullback in the stock. And then another attempt to go through a resistance level, the high that has been set by the stock previously, and then a move down in the stock. As it breaks through this level right around 31, that's the point where we want to go short the stock. So you can see we have the M pattern. As the bulls are in control, they lose control and the stock pulls back. But if the stock were to continue higher here in late September and break above this resistance level, then the bull move would still be intact, but the stock doesn't. It pulls back. Now, if it were to hold this support level now and move higher, it would still be a buy and still be in the bull pattern. But the stock breaks through here in late September to the downside. And when the stock breaks to the downside, that's when we want to either sell our long position that we've held during this bull run, or we may want to go short the stock as it completes the double top pattern. So that's a double top in AMD reversing a bullish pattern with the stock now in a bear trend. Now let's look at a double bottom in the stock of Intel. The stock is in a bearish trend. It makes a bottom here right around the 33.5 level. The stock bounces higher. The W and M pattern do not have to be perfect. The stock then comes back, retests the low for a second time, and then finally moves higher, goes through the pullback high, and continues higher. It is at this point that we would have either covered short positions we may have had in the stock or go long the stock as it completes the double bottom pattern and moves higher to the upside. So that's a double bottom in the stock of Intel. In a head and shoulders pattern, a stock is in an uptrend. It reaches a high, pulls back, and then reaches a subsequent higher high. And at this point, the uptrend is intact as we're making higher highs and higher lows. The stock then pulls back a second time, attempts to make another high, and is only able to climb as high as the first high in the pattern. So it's now in the process of making a lower high after this second pullback, and then the stock continues to make a lower low when it breaks through the neckline of the pattern. And the neckline is the trough of the first two pullbacks. So what we have going on from a psychological level is that the stock is performing as it should, making a higher high and a higher low, but then that pattern reverses itself, and we have the stock making a lower high and then a subsequent lower low. This tells us that the bull trend has come to an end, and the stock will either move into a consolidation pattern or may move into a bearish pattern. The result is that the pattern looks like a head and shoulders, with the shoulders being the two lower highs and the head representing the highest high that the stock makes in the pattern. So when you break down the head and shoulders pattern, as I just said, it's the stock moving from a pattern of higher highs and higher lows to a pattern of lower highs and lower lows. So let's take a look at a head and shoulders pattern on a chart. Let's use a chart of 3M for our head and shoulders pattern. Here we see the stock is trading on a daily basis, and we see the stock making a new high here, continuing its uptrend. The stock then pulls back, rises higher. So this first high is our shoulder, and then we have a head here. The stock pulls back again to this level, attempts to rise, and our second shoulder, it doesn't get quite as high as the first shoulder, and then the stock moves down. Now in this case, the stock breaks the neckline, which is here. So we have our head and shoulders pattern complete, and then the stock rallies again, but it's unable to close above the high reached in the second shoulder. So our trade remains intact. If we're to go short the stock, we want to use the high of the second shoulder as our stop. And with the stock not having a close above this high, we would have maintained our short position. And then we can see the stock falls off, moving from this 80 level down to the 74 level. A perfect head and shoulders pattern is fairly rare in the charts, but as we can see, this pattern holds the psychology of the trade, where we're making higher highs and higher lows, and then the stock reverses to making lower lows and lower highs. And again, we can use that second shoulder as our stop, because that's our resistance level now with the stock. So if we take a short position at the neckline, we can use that second shoulder as a stop for our short position. A reverse head and shoulders is just the opposite. You'll have a stock in a downtrend. It'll make a low, rally back up, make a second lower low, which is the reverse head, rally back up, and then make a third low that matches approximately the price point of the first low, which would then be your second reverse shoulder, and then rally above the upside down neckline. And with that pattern, we would go long the stock, or definitely cover our short position if we're short the stock, which has been in a previous downtrend. So that's the head and shoulders pattern in the stock of 3M. Triangles, flags, and pennants are continuation patterns in either an uptrend or a downtrend. Our graph to the left shows a flag continuation pattern in a bullish uptrend. The pattern represents a price consolidation with minor support and resistance levels. We can use these support and resistance levels as buy signals in the trend. If you'll remember, we talked about exponential moving averages and how we could use those as support levels to give us buy signals and sell signals in a trend. We can use triangles, flags, and pennants in the same way. So what we're looking for is the stock to pull back in a bull trend, and when the stock breaks the upper portion of the resistance within the triangle, flag, or pennant, that break can be taken as a buy signal for the stock. The same is true in a bear trend when the stock is trending down and then pulls up in the pattern to form a triangle, flag, or pennant. When it breaks the lower bound of support in that pattern, then that is taken as a signal to enter the stock on the short side. A flag, which is represented here on the graph, looks like a rectangle. A pennant looks like a symmetrical triangle, and a triangle looks like a triangle on the chart. And we can have both ascending and descending triangles. So let's take a look at triangles, flags, and pennants on a chart. Let's look at our first pattern, which is a flag pattern in the chart of Intel. Intel was trending up. We have the stock in an uptrend. And we see a pullback in the uptrend here. That's the upper bound of the flag. And here's our lower bound of our flag. After this 3-day pullback, on the 4th day, the stock breaks the upper bound or the resistance level of our flag and moves to the upside. This could have been our buy signal, or we could have purchased the following day after it was clear that the stock had broken this short-term flag pattern. The stock continued to move up from here, which is around the 25.5 level, up to around the 29.25 level before turning down. So this was a continuation flag and a bull trend in Intel, and gave us a buying opportunity when the stock pulled back. Now let's use the chart of Qualcomm to look at a pennant pattern. We have Qualcomm, and we're looking at an hourly chart, and you'll often see flags and pennants and triangles on hourly charts. They can help guide your trading on a shorter term basis. So if we look here in July, on July 18th, we see that the stock is moving up, has a slight pullback, and then continues the bullish pattern. And then for several hours, we have a pullback here and support here, which is around 50% of our green candlestick, which is also an important number. And here we have a pennant. So when the stock breaks out at the end of the pennant pattern, it moves up, comes back and holds the support level, and then moves up a little more. We then have the stock coming back and testing this support level, which we can continue to draw here, and then moving up, bouncing off support, moving up, bouncing off again before it finally moves up off the 58 level, back up to the 62 level and beyond. So our pennant ended up being longer term support on an hourly chart, which we could have used to keep us in a long trade until the stock finally made a move higher. So that's the stock of Qualcomm with a pennant pattern, again breaking out to the bullish side of this pattern, coming back, touching support several times, and then finally moving higher. The cup and handle pattern is named cup and handle because the shape of the trading pattern of the stock looks like a teacup. You have a bowl-shaped pullback in the stock, and then a move back up, which forms the right-hand side of the cup. We then have a pullback in the stock. Ideally, it will be to around the midpoint between the lip of the cup and the base of the cup, but is often more shallow. And then we'll have a move up in the stock from the downward sloping cup. And when the stock breaks the downward slope, that is the buy signal for the cup and handle pattern. The cup and handle forms a resistance pattern because the lip of the cup on the left side and the right side is a resistance point, and then the handle looks like a flag pattern as the stock pulls back after touching resistance a second time. So psychologically, you've had owners of the stock who have been underwater as the stock pulls back into the base of the cup. When the cup gets back to the right-hand side of the lip, you're back at resistance. So the buyers who purchased there and have been underwater the entire time the cup has been forming are now selling the stock and pressuring it, which causes the handle of the cup, your flag pattern, as the stock moves back down from encountering selling pressure. And then you have a move out of the handle to the upside, which is your buy signal. As a secondary buy signal, you can use the resistance level, which is formed at the lip of the cup. So let's take a look at the cup and handle pattern on a chart. We're going to use the chart of AMD Advanced Micro Devices to look at a cup and handle pattern. The beginning of our cup is here. We have a pullback, and I've drawn a curve so we can see what the cup pattern looks like. The second lip of our cup is here. And then we have a slight pullback in a flag pattern. And ideally, we would want the handle to come a little bit lower into the cup, but the psychology is the same. The stock has hit the resistance level formed by the left side and the right side of the cup. When it touches that resistance level, you get sellers who've purchased the stock back at the end of June and are now back to even, and they're selling here in October. This forces the stock down, and then we get a break of both the resistance level and the handle, as well as the resistance level for the cup overall. As we can see, once that resistance level is broken to the upside, the stock continues to move up. So we get a movement from $16 all the way up to around $25 for the high of the stock. If you'll remember, we talked about earlier that a support or resistance level that has been in place for a longer period of time usually gives you a bigger move than a support or resistance level that has been in place for a short period of time. With a cup and handle pattern, we are looking for a move that would equal the measurement from the base of the cup, which in this case was around $11, to the lip of the cup, which was around $16. So we're looking for a $5 move, the difference between 16 and 11, when the stock moves up. We actually end up getting a much larger move than the $5 that we get from not only 16 to 21, which would have been the $5 move here. And we see this stock encountered a little bit of resistance at this point. It was able to break through, retest this resistance level, and then move higher up again, as we talked about, to the $25 level. So that is the cup and handle pattern in the stock of AMD.